Good work on the poll. So we have it there. And actually, we have 59% for pressure for lower fees. And this, the audience thinks, Anne, is the biggest shift in investor behavior during the last 5 years. So we'll talk a little bit about this and basically what you're seeing as one of the behaviors. Does that seem right? 63% for pressure for lower fees.
I think it's interesting the way the question has been phrased. I mean, I think it is a huge shift in the way that the external environment is operating for us. I'm not sure this is the most important one of the four when I just look at that. Because in a way, I think we are still waiting for our motor industry kind of moment. You know, when you think about when the Japanese car manufacturers came in and completely radically changed the way that the car industry worked by introducing automation, by streamlining production lines, by just totally shifting both the quality and the price point at which a car could be delivered. And I think in the investment management world, we've seen the external environment begin to change, but we've not begun to understand that we need to go through our own Japanese car industry moment, which is how in my mind I think about it. So, you know, I think in terms of the pressure for lower fees, we've got to get ahead of that curve, but I think some of the other things are actually probably more radical and more important for us to, because I think that's one we can fix if we really focus on our manufacturing. I think some of the others require much more creativity to how we address the problems.
Yeah, and so we're focusing on basically the shifting overton window, and overton is the range of ideas which are considered acceptable in a democracy as being basically prized as society experiences huge disruptions. We could talk about Brexit, we could talk about US-China trade wars, and you can talk about climate change. What do you see as the biggest shift? So if it's not pressure for low fees, is it sustainability or is it technology?
That's a really tough one, actually. I mean, technology is a kind of interesting one. I've had a traumatic start to the day, because not only did I get the wrong coffee from the coffee shop this morning, and there's nothing worse than that first coffee of the day, having milk in it when you really don't want milk in your coffee. Francine sorted that with a lovely espresso, so her inner Italian coming out there. But actually, when I woke up this morning, I have 2 iPads and I have 2 iPhones. And the only one that was functioning this morning after an overnight iOS upgrade was my iPhone 6, which tells you something about how everything else works. So, of course, my IQ has immediately dropped by about 40 points when you don't have access to the internet. But I think actually technology, in terms of how it's shifting the decision-making framework that we can all use, is very, very radical in terms of how we can, in fact, adapt to some of those things that are out there. And I think technology is something we probably come back to. In terms of the external demand, in terms of what society as a whole expects from us as investors, there is a growing cohort and a growing understanding that the shareholder supremacy that has really been the model that we've had pretty ubiquitously since the 70s is now not the only, it's not what society expects of us when you think of our collective power that we have by accumulating lots of small pots of money into creating a single big pot of money and then the responsibility that comes with that. I think there's lots of different strands to that. But I think that from the demand side is becoming increasingly important it's part of our contract with society.
So does that mean more sustainable investments? And how much is that growing? How much appetite is there for sustainable investment?
So I think it's very, very varied, because when we lump the ESG factors into a group, every country that you go to, every client that you go to will have a different take on what they regard as important in a whole set of ESG factors. And it's not every client that is yet convinced that there are other other returns that matter other than financial returns. I think where we come from is that many of the things that we put in an ESG bucket as an industry at the moment are simply things which are not financial yet. And I think that's what you've seen, like for the US Business Roundtable, for example, sort of collective letter, the understanding that there are many things which go into that return on equity or return on capital calculation, and that we need to get a much broader view of how you think about the impact of all of those things in creating that financial return, which does include thinking about what it is that as a business you borrow from society. So I think it's a complex map that we have. But as you sit in London today, and we've got the climate change protests going out there, you can see that there is a demand from society for us, in part, to change what we do. I think we have to respond to that.
What will be a game changer for that? Is it new products? Is it actually more transparency to understand what we're looking at?
Well, I think I think what we've tried to do within Fidelity is we've tried to change from backward-looking measures to forward-looking measures. So of all of the thousands and thousands and thousands of company visits that we do around the world today now, we are now actively considering what the ESG impact is of any individual company that we talk to, regardless of whether it's going into an ESG-specific mandate or not. But actually, I think it's more than one company can do, and what I've been trying to encourage is a collaborative effort that goes from backward-looking measures into forward-looking measures, because what we're trying to do is encourage companies to think about, as an industry, we should be trying to encourage companies to think about the things which are not financial yet, but which will become financial, and how we build that to create an economy that is more sustainable. And I think demographics help us with that, because with an aging population, the demand for aggregate GDP growth, for example, becomes less. So I think that broad shape is very, very important, because frankly, as a world, we're going to run out of stuff if we don't get better about reuse and sustainability. So I think it's an imperative on all of us to do that.
So what does it mean for Fidelity International?
So what we're trying to do is every single company in our universe, we are now rating on a forward-looking impact measure. So we're thinking about what the impact is, and we're rating every company on a 5-point scale on that basis. So when we look at any portfolio, when we do our quarterly fund reviews, we can now look at what the impact of any portfolio is likely to be on those broader ESG measures. And they're forward-looking. We're not trying to restrict companies from it. We're trying to say, this is how we rate you as a company, and this is what it means for the overall shape of the portfolio. So we can give that transparency to any customer who comes and look, and they can make an informed choice. Do they want a portfolio that has an impact of this, or a portfolio that has an impact of that? And how does that compare with the index, which, by the way, we can also rate on the same way? So that's what we're trying to do. We're trying to give transparency around about that.
Do clients ask about it? Or at the moment, do they just look for yield?
So clients ask about it, but yeah, it depends where you are on that one. I mean, yield is a big thing. Yield is a very, very big thing. We talk about client demands. A lot of people out there are still struggling. They want income, and how do you find income in a world where there's an awful lot of the yield curve? It doesn't give you that. The name is a bit of a misnomer. But the other big cohort that we get asked about, who ask about this a lot, is actually our employee base and prospective employees. I mean, it comes up in interview now as a question that we are asked. What are you doing about it? How do you think about this? In a way that probably 5 years ago it didn't happen. So I think we have to understand that the shift is coming from both sides, both from the client-led side and actually from our employee side as well.
And talking about yields, so are clients asking riskier stuff because they just want that return, which is so difficult to find?
Well, it's kind of. I really struggle with, how do you find a risk-free rate when the benchmark measure of risk-free rate is guaranteed to lose your money? I mean, we've talked about that before. I find that quite hard to get my head around. So if you define risk as volatility, people are clearly able and willing to take more volatility because of that search for yield. I think you can definitely see that. But I think it is also pivoting us into the world of private assets more, because one of the ways actually you get some volatility, and you could argue this is a complete veil. I mean, it's not a true measure, but because the pricing points are much slower, you get much less apparent volatility. I think it is only one of the things driving the flows into private markets, but I think it is part of that. In private markets, you have less volatility, and you can get a higher yield point for point than you can typically get in public markets.
But it's riskier. So is it something that you worry about? We talk also about risks about surrounding liquidity.
Yeah. So I mean, riskier. Risk is a very. If you were to ask everybody in this room to define risk, you would get a whole range of different measures around risk. So what is it, the risk that we care about? Is it liquidity risk? Is it counterparty risk? Is it maturity mismatch risk? Is it short-term volatility? Is it the risk of permanent loss of capital? And so I think the landscape that we're in today is one of saying, well, we have to choose which is the risk that we want to be exposed to with a particular segment of your portfolio, of your assets. There is nothing that gives you something that we would have considered to be a truly risk-free investment in the way that we would have done pre-crisis. And we've not really, post-crisis, had that complete confidence in anything, I would say.
But do you worry about liquidity in the markets?
I do worry about liquidity. I think one of the things that we can see changing, partly with the geopolitical situation, where you can see trade wars putting a lot of friction in the movement of trade around the world, right down to share listing spats between the EU and Switzerland and the UK, what you're seeing is a fragmentation of capital markets. So we're no longer in a world where the kind of prime motivation of those involved in markets, the political will, if you like, to create more and more frictionless flow of capital around the system. We're definitely seeing fragmentation of markets as a political weapon. And that does bother me, because I think that introduces additional stresses into the system in a way that we've not had to consider for really quite a long time. And so with that fragmentation of capital markets, and we know particularly in European markets, capital markets are not deep in any case. In Europe, we do have a banking system that has not been effective in terms of transmission of loose monetary policy through to the real economy anyway. So when you put that together, I'm worried that there is more of a liquidity strain in capital markets globally than we're all currently live to. And I think we need to really continue to work politically to push for that continued free flow of capital around the system in order to make sure that we don't end up with the sort of hiatus which then tips you into a counterparty event, which then tips you into something which begins to feel like a more systemic financial issue around the world. And I think we're perhaps more uncomfortably close to that than most of us in this room would like to be.
But so are you taking protection for Fidelity, or does it change the way that you run things?
Well, we're quite fortunate. I mean, we operate in more than 25 different countries around the world, and so we have trading desks and analysts and fund managers in multiple different jurisdictions, which gives us more scope to be able to pass the book and find the liquidity pockets where they are. So, in that sense, we've got some natural protection in there. But you have seen in the conversation, I don't want to mention the Brexit word, but you have seen as people have reshaped their businesses over the last 3 years. One of the things that it has typically done is it's meant fund management companies have typically replicated trading and investing capability inside and outside the EU as a way of hedging against whatever environment might be. And that is an example of how we've had to respond to that world. So I think you will inevitably see more of that as we respond to this more fragmented world. And I think that's only going to continue.
What about quants? How has that changed?
Yeah. So the quant, I think, is really interesting. We've been doing some really interesting stuff that's trying to pull together kind of some of the, if you like, the behavioral science side of thinking more analytically about how markets behave and respond, sentiment analysis and that kind of thing, as well as thinking about how we can use more disciplined techniques in things like portfolio construction. And we've been trying to pull together, we've got some fantastic work that we've been doing to think about how we can use some of these techniques to both help us build smarter portfolios and help us trade more smartly in what we do. But actually, if we get some of this right, then I think we can start to tackle some of the issues around when we talk about that. How do you respond to fee pressure? You think about how you change your manufacturing base. For things like hold to maturity mandates in the fixed income world, we can use quantitative techniques to help us. So we still do the fundamental analysis at a human level, but you can use quantitative techniques to build the portfolios to then do the liability matching, for example. And so that's a way how you can actually still make a good margin on something, but at a much lower fee price point. And we've just got to get smarter of that. So I think that combination of the behavioral, the fundamental analysis by humans, and thinking about how you can use quantitative techniques around portfolio construction is quite powerful. Actually, I think there's a lot more for us to do, both as a business and probably as an industry.
Will we still have humans in 5-10 years actually talking to us, or is it going to be Robo Advisors?
No, I think I'm reasonably confident we will still have humans. Yes, I think generally on the planet. 50 years, who knows, but 5 years definitely on the planet. But no, absolutely we will. Absolutely. And there's a real psychological point to this. I mean, in the last 10 months or so, this year, I've done more than 150 different client meetings. And I actually spent time last week, I do this periodically, I went down into a call center and I spent time on the phones. I've got to say, when you're actually taking a phone from a customer, it's a really stressful thing to do because they can ask you anything. And if you have it in your business, I do recommend go and do that periodically because it brings There's nobody phones you up and say, I'd rather talk to a robot. Nobody's done that ever. So, I think that the last mile for our industry, there is, for many, many people, for the foreseeable future, there's going to be that desire to have the human contact. And I think with all the stuff around robo, I think there's a huge body of evidence which shows people love being able to do quite objectively and on their own a lot of the analysis, a lot of the research, getting to a point of comfort about what they think they want to do. There are very few people, when it comes to a large proportion of their personal wealth, are really comfortable flipping the switch without having sense checked it against a human being, talking to somebody. And that's pretty much true in every country that we operate in around the world, which is interesting. It's reasonably culturally agnostic. So I think there's a lot of power that we can still bring to help people make financial choices. I think there's more that we can do there. I don't think it's ever going to take humans completely out of the equation, either in the touching the customer side of it or right at the back end in terms of doing the fundamental analysis. It was a great quote. It was a great statistic came out of a piece of broker research this week, which said something along the lines of over the last 90 years, almost all of the stock market returns have come from 4% of companies. I mean, it's that level of concentration that we see, which is why I think capital allocation, active management, and the human proportion of that can rate a management team and figure out what we do with it is never going to entirely go away. I think that's a really powerful reason why active allocation of capital is going to remain a very important part of the investment universe. We just have to get smarter about how we deliver that.
I am getting questions from the app, so just keep them coming. I have a couple of testing, is this thing on? It is. So just submit questions.
So that was the first answer.
I'll come to that in a second. But how do you look at crypto and digital currencies? Will the disruption be coming from big tech or central banks?
Well, if you had to choose between, if it was a sort of straight off wall-to-wall fight between fintech or even big tech and central banks, at the end of the day, central banks are close to the people that write the laws. I actually think eventually central banks win that one. I mean, the joke that I say, and it's a joke, but it's tongue-in-cheek, but it's not entirely tongue-in-cheek. If you go back in history, the last corporate that had the ability to issue its own currency was the Dutch East India Company, which was allowed to, for almost 200 years, create the most enormous monopoly the world has ever seen. It, by the way, could also try people and hang them if it didn't like what they did. It had its own army. So I don't think we've quite got to that point with big tech yet. But it is interesting that the power of corporates to issue currency, it's an experiment that's been tried before in history. So, and eventually government took back control. So on that front, I think we are more likely to end up with digital currencies that are ultimately central bank controlled. But it is worth saying there are many different flavors and variants to digital currencies that can go from true crypto, like Bitcoin, which is completely anonymized, to digital currencies which are not necessarily anonymized in the same way, and there's a huge raft of variants that sit in between them. And I think we are moving into a digital world. We're basically already into a digital currency world. So, I think, but I would say central banks will win that one eventually. Not necessarily in the short term, but in the long term.
And let me ask you just one question from the floor, which is, given all the shifts, where does Fidelity International sit in the next 10 years?
So I think we have effectively six channels which are our lens onto the world, which are the classic wholesale institutional channels on the pure asset management side, and then everything from DC pensions, personal investing, advisor networks, stock plan services. So we have a very ubiquitous lens on the world. I think in 10 years' time, the world that we will sit in is we will still be making and doing the investment things which have made Fidelity great in terms of the intellectual creativity, but that customer centricity and that ability to pull together across all those different channels to give people a single view of their financial well-being, a sort of financial health service and wealth service that sits at the center of that. That's what we aspire to create. So that's what I hope we'll be doing in 10 years' time.
Anne Richards, thank you so much, Chief Executive of Fidelity International.
Thank you.